Welcome back to XRP On Moon, the channel where we break down the biggest XRP developments, hidden signals, and future predictions that most people are still sleeping on. Today's topic is something that could completely reshape how you look at your XRP holdings because three advanced AI models have just released projections for XRP's price in 2026, and let me tell you, the numbers they're pointing to are not just surprising, they're downright shocking. If you're holding XRP, thinking about buying it, or even just watching from the sidelines, this is one of those moments where you need to pay very close attention because what we're about to uncover might challenge everything you thought you knew about where XRP is headed. Now, here's the thing. AI models are no longer just experimental tools. We're talking about systems trained on massive data sets, analyzing historical price patterns, global liquidity flows, regulatory developments, and even macroeconomic signals all at once. These models don't trade on emotion, hype, or fear. They process probabilities. And when multiple independent AI systems begin to align on a similar outcome, that's when smart investors start to take notice. Because it's no longer just speculation. It becomes a pattern worth investigating. So what exactly did these three AI models predict? Without jumping too far ahead, what's fascinating is that all three models, despite using different methodologies, arrived at one common conclusion. XRP could be entering a phase that the market has never seen before. One model focused heavily on institutional adoption trends, analyzing how banks and financial institutions might integrate XRP into cross-border payment systems. Another model was trained on regulatory timelines and legal outcomes, especially considering how clarity in the crypto space tends to unlock massive capital inflows. And the third model? It took a macro approach, evaluating global liquidity cycles, inflation trends, and how digital assets like XRP fit into the future financial system. And here's where things start to get really interesting. All three models pointed to 2026 as a potential breakout window, not just a random year, but a convergence point, a moment where multiple catalysts could collide at once. Think about it. Increasing institutional adoption, clearer regulations, and a shifting global financial system that's slowly moving toward blockchain-based solutions. When you combine all of that, you don't just get gradual growth, you get exponential moves. But before you get too excited, let's ground this in reality. Predictions, even AI-driven ones, are not guarantees. They're scenarios based on available data. However, what makes this situation different is the level of alignment between the models. Usually, predictions vary widely. One might say XRP hits $5, another says $20, and another stays conservative at $2. But in this case, the projections were not only bullish, they were clustered within a range that suggests something much bigger could be forming beneath the surface. Now imagine this for a second. What if XRP is not just another crypto asset, but a key piece of infrastructure for the next generation of global finance? That's exactly what one of the AI models suggested. It highlighted XRP's utility in facilitating near-instant cross-border transactions with minimal fees, something traditional systems have struggled with for decades. If even a fraction of global transaction volume starts flowing through XRP-based systems, the demand dynamics could shift dramatically, and as demand increases in a system with limited supply, price becomes the natural pressure valve. Another critical factor the AI models considered was the psychological aspect of the market. Yes, even machines account for human behavior. Once XRP breaks certain key price levels, it doesn't just attract retail investors, it triggers institutional FOMO. Large players who were previously hesitant start allocating capital, not because they suddenly believe in the technology, but because they can't afford to miss out. And that's when markets tend to move the fastest, not at the beginning, but when the crowd finally realizes what's happening. But here's the question you should be asking yourself right now. Why 2026 specifically? Why not 2024, 2025, or even later? According to these AI models, 2026 represents a timing alignment. Regulatory frameworks are expected to mature, central banks are likely to accelerate their digital currency initiatives, and financial institutions may reach a tipping point in blockchain adoption. In other words, it's not just about XRP, it's about the environment around XRP becoming ready. And if that environment does become reality, then the price predictions we're about to explore in the next parts might not seem so crazy after all. In fact, they might end up being conservative. What makes the first AI model so compelling is not just the price it predicted, but the way it arrived at that prediction. This wasn't a simple trendline projection or a basic technical analysis model looking at past charts. This system was designed to analyze institutional behavior, specifically how banks, payment providers, and financial networks are gradually integrating blockchain technology into their infrastructure. And at the center of that analysis sits XRP, not as a speculative asset, but as a utility-driven bridge for liquidity. The model pulled data from multiple layers of the financial system. It looked at cross-border payment volumes, which currently move through outdated systems that are slow, expensive, and inefficient. Then it compared those systems with blockchain-based solutions, particularly XRP's ability to settle transactions in seconds. From there, it calculated what would happen if even a small percentage of global payment volume shifted toward XRP-powered networks. And this is where things started to escalate quickly. According to the model, if XRP captures just a fraction of the global remittance and interbank settlement market, the demand shock could be enormous. We're not talking about retail investors buying small amounts. We're talking about institutions needing large quantities of XRP to facilitate liquidity. And unlike retail trading, institutional usage creates consistent, ongoing demand. That kind of demand doesn't disappear overnight. It builds, compounds, and tightens supply over time. But here's the key insight the AI uncovered: liquidity efficiency. Traditional systems require pre-funded accounts in multiple countries, locking up billions of dollars globally. XRP eliminates that need by acting as a bridge currency. The model estimated that if financial institutions begin replacing even a portion of these pre-funded accounts with XRP-based solutions, it could unlock massive capital, and at the same time, drive demand for XRP itself. It's a double impact. Capital gets freed up, and XRP becomes the mechanism enabling that efficiency. Now let's talk about the price projection, because this is where the conversation shifts from interesting to potentially life-changing. Based on its analysis, the AI model generated a projected XRP price range for 2026 that sits significantly higher than current levels. And what's important here is not just the number, but the reasoning behind it. The model didn't assume hype cycles or viral trends. It assumed adoption, real usage, real demand. The projected range it identified falls between $18 and $27 under moderate adoption conditions. Not extreme, not unrealistic, just a steady integration of XRP into financial systems over the next few years. And if adoption accelerates beyond expectations, the model showed scenarios where XRP could push well beyond that range, entering territory that most retail investors today would consider unbelievable. But before you dismiss this as overly optimistic, consider how markets behave when utility meets scale. We've seen it before in other sectors. When a technology becomes essential infrastructure, its value doesn't grow linearly, it grows exponentially. And according to this AI model, XRP has the characteristics of infrastructure, not just an investment asset. Another fascinating detail is how the model accounted for regulatory clarity. It didn't assume a perfect environment. Instead, it mapped out different regulatory scenarios and their impact on adoption speed. In scenarios where regulations become clearer and more supportive, the model showed a rapid acceleration in institutional involvement. On the other hand, even in slower regulatory environments, the long-term trajectory remained upward, just delayed, not denied. The model also highlighted something that many people overlook: network effects. As more institutions adopt XRP for liquidity, it becomes more valuable for others to join the network. This creates a feedback loop where adoption drives value, and value attracts more adoption. It's the same dynamic that powered the growth of the internet, social media platforms, and even global payment networks. Once a certain threshold is reached, growth becomes self-reinforcing. And here's where things get even more intriguing. The AI model identified a potential tipping point, an adoption threshold where XRP transitions from being an option to a necessity for certain types of financial transactions. Once that shift happens, the demand curve doesn't just rise, it steepens dramatically. That's the kind of phase transition that can lead to explosive price movements in a relatively short period of time. But the model didn't ignore risks. It factored in competition from other blockchain projects, potential delays in institutional adoption, and macroeconomic uncertainties. Even with those risks included, the overall outlook remained strongly bullish. That's what makes this prediction stand out. It's not based on perfect conditions, but on realistic, data-driven scenarios. So when you step back and look at the bigger picture, this first AI model isn't just predicting a higher XRP price. It's outlining a structural shift in how value moves across the global financial system. And if XRP plays even a partial role in that shift, the implications could be far greater than most people realize today. Now, the second AI model takes us in a completely different direction. And honestly, this is where things start to feel even more intense. Because instead of focusing on adoption or institutional flows, this model zeroes in on one of the most critical and often underestimated factors in the crypto space: regulation. More specifically, it analyzes how legal clarity can act as a trigger point for massive capital inflows, especially from institutions that have been sitting on the sidelines waiting for the green light. This model was trained on decades of financial market behavior, studying how assets react when regulatory uncertainty is removed. and the pattern it found is both simple and powerful. When an asset transitions from legally questionable to legally accepted, it often experiences a rapid repricing event. Not gradual growth, not slow accumulation, but a sharp, aggressive move upward as confidence floods back into the market. Now think about XRP for a moment. For years, one of the biggest barriers holding it back has been uncertainty, not necessarily the technology, not the use case, but the question marks surrounding its regulatory status in major markets. This AI model treated that uncertainty as a variable, something that, once resolved, could unlock suppressed demand almost instantly. So what did it do? It mapped out multiple legal scenarios, including timelines for regulatory clarity across key financial regions. It looked at how governments typically approach emerging technologies, how long legal disputes tend to last, and what happens after they are resolved. And based on that analysis, the model identified a critical window where XRP could transition into a fully recognized and institutionally accessible asset. Here's where it gets really interesting. The model didn't just assume that clarity would bring in retail investors, it focused on institutional capital. Hedge funds, asset managers, and even pension funds that are currently restricted from investing in assets with unclear legal status. Once those restrictions are lifted, even partially, the amount of capital that could flow into XRP is on an entirely different scale. And according to this AI model, that influx of capital wouldn't trickle in slowly. It would likely arrive in waves. The first wave would be early institutional movers, firms that have already done their research and are just waiting for confirmation. The second wave would be broader market participants reacting to price movement and momentum. And the third wave, that's when mainstream attention kicks in, bringing a surge of retail investors back into the market, amplifying the move even further. Now let's talk about the price projection this model generated, because this is where things take another leap. Based purely on regulatory clarity and the resulting capital inflows, the model predicted that XRP could reach a range between $35 and $50 by 2026. And again, this isn't based on hype. It's based on historical precedents of how markets behave when uncertainty is removed and access is expanded. But what makes this model particularly powerful is how it accounts for timing. It doesn't assume that everything happens at once. Instead, it shows a sequence, a chain reaction. First comes clarity, then confidence, then capital, and finally price acceleration. Each step builds on the previous one, creating momentum that can carry the asset far beyond its previous highs. Another key insight from this model is the concept of repricing gaps. These occur when an asset has been undervalued for an extended period due to external constraints, in this case, regulatory uncertainty. When those constraints are removed, the market doesn't always adjust gradually. Sometimes it jumps, skipping price levels as it rapidly recalibrates to what it perceives as fair value. That kind of movement can catch a lot of people off guard, especially those waiting for perfect entry points that never come. The model also analyzed how media narratives shift once legal clarity is established. Negative or cautious coverage tends to fade, replaced by more optimistic and forward-looking discussions. This change in narrative plays a bigger role than most people realize because it influences public perception, which in turn affects investor behavior. And when perception shifts from doubt to confidence, demand can increase dramatically. Of course, the model didn't ignore potential delays or complications. Regulatory processes are rarely smooth, and timelines can shift. But even when factoring in slower progress, the overall trajectory remained upward. The difference was timing, not direction. Whether the breakout happens sooner or later, the model suggests that clarity is the catalyst that eventually unlocks XRP's potential. And here's something that really stands out. The model identified that once XRP gains clear regulatory status in one major financial region, it could create a domino effect globally. Other regions often follow, either to stay competitive or to align with international standards. That means clarity in one place doesn't just impact one market, it can ripple across the entire global financial system. So when you combine everything this second AI model is showing, you start to see a very different perspective. It's not just about technology or adoption, it's about permission. The moment XRP is fully allowed in the eyes of major financial systems, the floodgates could open in a way that very few people are prepared for. Now, the third AI model steps back even further and looks at the biggest picture of all, not just XRP, not just regulation, not even just institutional adoption, but the entire global financial system and how money itself is evolving. And this is where things start to feel less like a simple price prediction and more like a glimpse into the future of finance. This model was built to analyze macroeconomic cycles, things like global liquidity, inflation trends, central bank policies, debt levels, and currency devaluation. It studies how capital moves during different economic phases, and where it tends to flow when traditional systems begin to show stress. And what it found is something that aligns with what many forward-thinking analysts have been quietly discussing for years. We are entering a period of transformation where digital assets could play a much larger role than most people expect. The model started by examining historical liquidity cycles. Every time global liquidity expands, whether through stimulus, monetary easing, or financial intervention, capital looks for places to go. Traditionally, that capital flows into stocks, real estate, and commodities. But over the last decade, a new asset class has emerged, and it's been absorbing more and more of that excess liquidity, digital assets. And within that space, the model identified XRP as one of the few assets with a clearly defined utility tied to real-world financial infrastructure. Now, here's where it gets really interesting. The AI didn't just look at past cycles. It projected forward, analyzing how upcoming economic pressures could reshape capital flows. Rising global debt, increasing reliance on digital systems, and the push toward faster, more efficient financial networks all point toward a future where traditional systems may no longer be sufficient on their own. And in that kind of environment, solutions that offer speed, scalability, and cost efficiency don't just become attractive, they become necessary. According to the model, XRP sits right at the intersection of these needs. It's not trying to replace entire financial systems overnight. Instead, it acts as a bridge, something that can integrate with existing systems while improving their efficiency. And that positioning is critical because it lowers the barrier to adoption. Institutions don't need to completely overhaul their infrastructure to use XRP. They can gradually integrate it step by step. But the real driver in this model isn't just adoption, it's liquidity rotation. When large pools of capital begin shifting from one asset class to another, the impact can be massive. The model identified a potential scenario where, as traditional markets become saturated or less attractive, a portion of global liquidity starts rotating into digital assets at a much larger scale than we've seen before. And when that happens, assets with strong utility and established networks tend to capture a disproportionate share of that inflow. Now let's talk about the number this model produced, because this is where things become truly eye-opening. Based on its macroeconomic projections and liquidity flow analysis, the AI model estimated that XRP could reach a range between $75 and $120 by 2026, under high liquidity conditions. Yes, you heard that right. And before you immediately dismiss that as unrealistic, remember, this scenario is based on a significant shift in how global capital is allocated, not just incremental growth within the crypto market. What makes this projection different is that it doesn't rely on a single catalyst. It's not just regulation, not just adoption, not just hype. It's a combination of multiple forces all moving in the same direction at the same time. And when that kind of alignment happens, markets can behave in ways that seem impossible until they actually happen. The model also highlighted something called asymmetric upside. This is the idea that the potential gains of an asset can far exceed its perceived risk when certain conditions are met. In XRP's case, the downside is limited by its existing use case and network, while the upside expands dramatically if it becomes integrated into global financial flows. That kind of risk-reward profile is exactly what large investors look for, especially during periods of economic uncertainty. Another critical factor the AI considered was speed. In traditional markets, shifts can take years to fully play out, but in digital markets, things can move much faster. Once a narrative gains traction and capital begins to flow, price movements can accelerate rapidly. The model suggested that if XRP enters this macro-driven phase, the majority of its gains could occur within a relatively short time frame, catching late entrants off guard. It also explored how central banks and governments might indirectly influence this shift. As digital currencies and blockchain-based systems become more prominent, the infrastructure supporting them becomes increasingly valuable. XRP, with its focus on cross-border liquidity, fits into that narrative in a way that few other assets do. Even partial integration into these evolving systems could have a significant impact on demand. Of course, this model represents the most aggressive scenario of the three. It assumes strong alignment across multiple global factors, which doesn't always happen perfectly. But what's important is not whether the exact numbers are reached, it's the direction and the magnitude of the potential move. Even if the model is only partially correct, the implications are still massive. So when you combine everything we've covered so far, you start to see a layered picture forming. The first model showed us the impact of institutional adoption. The second revealed the power of regulatory clarity. And now the third has expanded the view to include global liquidity and macroeconomic transformation. Each model approaches XRP from a different angle, yet all of them point toward one consistent theme: the possibility of a major revaluation. AI models together, something becomes very clear. This isn't just random speculation or isolated optimism. Each model approached XRP from a completely different angle, yet all of them pointed toward one powerful idea: the potential for a major price revaluation by 2026. One model focused on institutional adoption and real-world usage, another highlighted the explosive impact of regulatory clarity, and the third expanded the lens to include global liquidity and macroeconomic transformation. Different paths, but all leading to a similar destination, and this is where things get interesting for you as a viewer and potential investor, because the real question is not whether XRP will hit exactly $18, $50, or even $100. The real question is, are the underlying conditions for growth actually forming? Because if even two out of these three narratives begin to play out at the same time, the upside potential could be far greater than what most people are currently pricing in. Think about it logically. If institutions begin using XRP for liquidity, that creates consistent demand. If regulatory clarity removes barriers, that opens the door for massive capital inflows. And if global liquidity starts rotating into digital assets, that amplifies everything. These aren't separate events. They can stack on top of each other, creating a compounding effect. And in markets, compounding is where the biggest moves are born. But here's the part that most people get wrong. They wait. They wait for confirmation, for headlines, for prices to already start moving. And by the time everything feels safe, a large portion of the move is already gone. That's how markets have always worked. The biggest opportunities usually exist in uncertainty, not in comfort. And XRP right now still sits in that zone where doubt and potential exist side by side. At the same time, it's important to stay grounded. Not every prediction will play out exactly as expected. Markets are influenced by countless variables: economic shifts, geopolitical events, technological competition, and even unexpected black swan scenarios. AI models are powerful, but they are not crystal balls. They provide probabilities, not guarantees. So what should you take away from all of this? First, understand the narrative. XRP is not just being viewed as a speculative asset anymore. It's increasingly being analyzed as a piece of financial infrastructure. That shift in perception alone can change how the market values it over time. Second, pay attention to the key catalysts: institutional adoption, regulatory developments, and macroeconomic trends. These are the signals that will tell you whether the AI predictions are starting to materialize in the real world. And most importantly, think long-term. The models we discussed are looking ahead to 2026, not tomorrow or next week. That kind of time frame requires patience, discipline, and a clear strategy. Emotional decisions, whether driven by hype or fear, rarely lead to good outcomes in markets like this. Now imagine this scenario. It's 2026, and even one of these models turns out to be close to accurate. The conversation around XRP would look completely different from what it is today. What seems shocking now could become the new normal, and the people who positioned themselves early, while uncertainty still existed, would be the ones who benefit the most. But whether that happens or not ultimately comes down to how these global factors unfold over time, and that's why staying informed, staying rational, and avoiding blind hype is absolutely critical in this space. Before we wrap up, I need to make one thing very clear. This video is for informational and educational purposes only. It is not financial advice. I am not telling you to buy, sell, or hold XRP or any other asset. Always do your own research, understand your own risk tolerance, and if necessary, consult with a qualified financial advisor before making any investment decisions. The crypto market is highly volatile, and while the upside can be significant, the risks are equally real. If you found this breakdown valuable and want more deep insights like this, make sure you stay connected with XRP On Moon. Because in a market that moves this fast, information isn't just power, it's everything.